In this video, I'm going to show you an advanced live analysis of the dollar Swiss in the 4-hour timeframe. This is an advanced trade because it deals directly with the market flow paradox that I already pointed out a few times here in the channel. The market flow paradox is the temporary suspension of the natural hierarchy between major and minor market flows. It's paradoxical because the minor flow seems to trump the major flow. However, there are ways that you can identify the market flow paradox in advance by looking at specific clues in the chart, and that's what this analysis is going to be about. Part of this early identification of the suspension in the natural hierarchy is to understand the fingerprints of large traders, and the types of preparation maneuvers they employ before attempting to manipulate a financial instrument. Let's begin with a low-resolution analysis, and then we will move on to increasingly greater levels of resolution. From number 1 to number 3.2 we have a simple market movement. The market made a lower high in number 3, and then it made a lower low in 3.2. For all intents and purposes, this means downtrend because for the market to display such movement, the sellers must be stronger than buyers. That's quite simple to observe, and most traders are able to grasp what that movement means. However, from point 3.1 onwards, things start to get a little bit trickier due to the appearance of a minor expanding pivot between 3.1 and 3.3. That could be confusing if you have difficulty in defining which market movements belong to the major flow and which movements belong to the minor flow. If you compare movements 1 through 3.2 with movements 3.1 through 3.3, I believe you would have no problem defining the first as part of the major flow and the last as part of the minor flow. However, since most of us are always eager to find trade opportunities as fast as possible, we tend to ignore the hierarchy between the major and minor flows. There are problems with this situation that can lead to errors. For example, after 3.3 broke the minor high 3.1, you could think that the market was indeed shifting its flow to the upside. An even bigger problem here would be believing that the market was under the flow paradox around 3.3, but there is a lack of evidence for that. The only thing we have at that point is the break of a minor high preceded by a minor reversal divergence right before 3.2. These are the inherent problems attached to expanding pivots. You could look for long trade opportunities after 3.3, but if you have objective triggers for your trades, you would not find any real opportunity between 3.3 and 4, which was the movement that should make you give up the idea of looking for long trades at least for the moment. This situation represents the fine equilibrium you must maintain between the subjective part of the analysis and the objective part of the analysis. Between 3.3 and 4 there are a few important details that are necessary if you want to forecast a flow paradox in real time. Right after 3.3, I drew two short lines. One of them is called press line and the other is called ignition down. In the sloped press line that precedes the ignition down, observe how the upper tail seems to be forced down. With each candle that forms, a lower upper tail is also formed. This is known as a press line. The ignition point is the point in the chart where the market seems to explode or give up to one of the sides. If we combine both lines and put them in context, we will see that the ignition to the downside occurred when the buyers gave up the idea of stopping the sellers that were producing the press line. This is important because the very moment where this ignition occurs can and should be used later to further the analysis. With number 4, the market structure in 3.3 is now considered to be a solid structure, and it could be later used as a safe stop-loss placement area theoretically speaking. Number 4 is also a fractal candle pointing to the upside, which begins the next leg of the market created by buyers. As a side note, observe that fractal candles occur mostly in the reversal points of the market, just like it happened in point 3.3. After number 4, price begins to rise, and this is where the analysis starts to become even more subtle and complicated. We have proven sellers that came out of the ignition point after high 3.3. If the sellers are going to appear again, they are going to do that in an area where there is intention like the air around the press line and the ignition point. However, just before price reaches the ignition point in 4.1, it displays an organized behavior. When you see organized behavior in the chart, you should be extra careful because the likelihood of large traders being active is high, and this is exactly the situation where the natural order of how price flows might be suspended. Observe that price reaches the ignition level where sellers should appear in 4.1. Price creates a bump down, and then it shoots up in 4.3. This is the most crucial point in the whole chart. The market vector between 4.2 and 4.3 disproves the sellers that created most of the vector between 3.3 and 4. However, the solid structure in high 3.3 is still not violated, which means that these sellers could still appear again, although it seems a lot less likely after the ignition violation. For all intents and purposes, without the violation of high 3.3, which is the major high, this is still a downtrending market. Here is where the flow paradox appears to confuse the hell out of most traders. Observe that we have a minor flow to the upside being formed between 4.1 and 4.3. At the same time, we are around an area where major sellers should appear, but they didn't appear in the level they were supposed to, which was the ignition point. Beyond that, we have surrounding details like the organized behavior to the upside. This is a situation where only subjectivity can really tell you what the best opportunity is, because objectively speaking, we should respect the hierarchy between the major and the minor flows of price. This is one of the reasons why analyzing the market can be very difficult. If we could always reach valid conclusions only using objective tools, trading would be a lot easier, but we all know that's not what happens in reality. In 4.3 we have another fractal candle pointing down, and its high coincides exactly with the high in 3.3. This could be a last resort if you really wanted to go short in this market. However, if you were aware of this whole situation regarding the market flow paradox, you would either play to the upside or play both sides. This idea of playing both sides when the market appears to be in suspended order like we are noticing here is an idea borrowed from game theory, and it's called the Perron-Doze paradox. This paradox states that a combination of two losing games can produce a winning strategy in overall terms. For example, if we go short after the fractal candle 4.3 and go long somewhere around 4.2, one of these trades will be successful. The key, of course, is placing both trades near the apparent edges of the market. Since both trades should have a risk-reward ratio of at least 1:3, the net result would be a profit even if you played for both sides. This is sort of an operational trick you could have up your sleeve. Coming back to the analysis, we can see that after our fractal candle 4.3, the market started to go down, and then a curious thing happened. Price pierces down the minor solid structure 4.2 and it closes the candle in a way that a large lower tail is produced. If we take into consideration everything we have talked about here so far, the interpretation of this candle should serve as a confirmation that large traders are indeed trying to trigger sellers to the downside. If large traders are trying to trigger people to the downside, they are probably intending to go long. Right after price pierced the 4.2 level, an inside candle with low volatility is formed. This is the decisive moment in this market because we will have a momentary pause, and then the market will resume its course, rendering one of the sides wrong and the other right. Once again, if we take into consideration all the elements that started to build up after 3.3, the trend bias should be to the upside. If we just look at this with cold objectivity without considering all these nuances, we will only sell the market, which is something that you would still be able to get away with assuming you collapsed risk rather quickly. The long trade you see opened in the chart was triggered in the third candle after candle 4.3, right after the decisive inside candle. Since we appear to be dealing with a manipulation, the stop-loss placement should be obvious. The stop-loss should be placed a few pips below the lower tail that intended to trigger traders to the downside. The target can be audacious because if we are correct, the beginning of a movement marked by a flow paradox is usually quite expressive. In this case, I will simply extend the range of the vector between 4 and 4.3 to the upside starting from the point 4.3. This should give us a risk-reward ratio around 1:6 and a profit of 210 pips in the 4-hour timeframe. Let's jump forward and see what happens. As you can see here, the flow paradox we identified in the chart gave birth to a quite strong uptrend. This is as hard as it ever gets in terms of market analysis. If you're able to understand how these things work, you will eventually become a good trader. If you enjoyed this video, don't forget to click the like button, subscribe to the channel, and leave your feedback below in the comment section. Thank you for watching.